Which of the FANG stocks is a better investment? We will look at it today, computing discounted cash flow valuations. Don't forget to click the like button and let's dive into the video. I published videos with the business analysis and valuation metrics for each of the FANG stocks. Therefore, if you are interested in the details of how I reached the valuation metrics, I encourage you to find those videos. I will link them in the description below. So let's jump right away in the valuation summary table. In the first column, we have the 5 FANG stocks. Here we have my prediction 10 years revenue growth rate based on both analyst estimates and my own estimates. If you are interested exactly all the thoughts behind how I reached this number, find the in-depth video in the link below. The 10 years free cash flow rate is here. The weighted average cost of capital for the business, it's here, and this is the discount rate used in the discounted cash flow valuation to derive the intrinsic value. Here we have the price to free cash flow multiple that I have predicted for the business. The only exception would be for Netflix, where I have computed the valuation with earnings instead of free cash flow. And the intrinsic value per share is in this column. This is the price that it would be fair to pay to have the business deliver you the return that you see in this column for the next 10 years. And in this column, you have a picture of how much are these businesses overvalued or undervalued as compared to what they are trading today. Furthermore, in these columns on the right, I have made the exact same calculation by keeping the discount rate constant for all businesses at 8%. What is evident is that based on my calculations, there are 2 stocks that came out undervalued, Meta and Google. Apple, Netflix and Amazon instead are overvalued. So I chose to keep on working on Meta and Google, and the next step was to compute a Monte Carlo simulation where I ran 1000 estimates of the intrinsic value of both Google and Meta. For Meta, I took analyst revenues estimates for the next 2 years, and then I estimated the revenue growth rate to be between 13 and 15% in the 3 subsequent years, between 5 and 11% in the 5 years after that. That means from year 2026 to 2031. For the free cash flow margins, I set it to be 15.5% in the next 5 years. This is what I have predicted the free cash flow margin to become next year. You can find the link below to find more details. 15.5% is well below the long-term average for the business, but Meta is undergoing an investment spree to keep up with its metaverse transition, and I don't see the investments tempering anytime within the next 5 years. Afterwards, I expect the margins to get better if either the metaverse transition starts making money or if they cool down spending. So I set the range to be between 20 and 25% for the year 2026 through 2031. The discount rate for the discounted cash flow valuation, I set it to be 9.8%, which is the weighted average cost of capital. The terminal multiple in year 2031, I predicted that Meta will trade between 10 and 25 its free cash flow multiples. It is a wide range because it is a huge unknown whether the metaverse transition will work out. If it does work out, I see multiples pushing mid-20s, but if it doesn't work out, the negative sentiment might push the multiples all the way down to 10. As a reference, today Meta is trading at 16 times multiples. Over here, you can see all the calculations, the estimated revenues, free cash flows, and discounted cash flows. And over here, there are the terminal values for the business in year 2031, calculated with either the terminal multiple method or with the perpetual growth model. Over here, I calculate the sum of the discounted cash flow values for the next 10 years, plus the average between the 2 terminal multiples. Correcting for current assets and subtracting total liabilities, we find an intrinsic value of the business that you see over here. These calculations was repeated 1000 times, and that led to the creation of this graph that you see over here. On the x-axis, we have the prediction of how much upside there is for the stock to reach its intrinsic value, and on the vertical axis there is the probability. As you can see, the majority of the simulations predict around a 20% upside for the stock to reach its intrinsic value. However, there is an uncertainty that around 10% of the simulations predict that the investment is undervalued by only low single-digit percentage or less. And the top 10% of the simulations instead predict that the business is 39% or more undervalued. In my opinion, this is a beautiful and elegant way to predict the business value, as well as visualize the best and worst case scenarios. Let's now move to Google, and this time I will be quicker. Once again, I took analysts' revenues estimates for the next 2 years in red over here, and then I input the growth rate between 10 and 15% in year 3 through 5, and between 7 and 10% in the 5 subsequent years. I estimate that the free cash flow margins will be between 20 and 25% in the next 10 years. The discount rate will be at 8%, and the terminal multiple in the year 2031 I expect it to be between 20 and 25. This gives us an estimated upside of the investment of just below 20% to reach its intrinsic value, with the worst 10% of the simulations predicting an upside of mid-single digits or less, and the top 10% of the simulation a return of 30% or more. In conclusion, among the FANG stocks, I calculated Google and Meta to be the better investments because their price today is below their intrinsic value. Among the two, I must say that I prefer Google, so I will give Google the crown. The reason is because it is a better risk to reward investment in my opinion. It is difficult to predict when and if Meta investment on the metaverse will work out. So there is simply a lot of uncertainty around the business model. I still like Meta as an investment though, and I see it as a more high risk to high reward type of investment. Google, on the other hand, is just so stable, has such a strong business moat, and it is undervalued, and that makes me like it the best among the FANG stocks. That's it for today. Let me know in the comments below which is your favorite FANG stock and why. And don't forget to click the like and subscribe. See you in the next video. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.